All right, what is up, and welcome back, everyone, to another episode of the Long Game Podcast. I'm your host, Thomas Kopelman, and here with me is probably the most repeated guest, I would say, Ben Lake. So Ben is an advisor that I partner with. He's at Composition Wealth. Really, really great advisor. Him and I probably work together on like 15 to 20 clients now. And what we really specialize on working on with these clients on is either really complex investment management or concentrated stock positions or really large sales that we need a lot of different estate tax planning, different tax planning tools. And so we brought Ben on today, and he's going to be on 2 episodes over the next couple months. And this one's really all about what we specialize in, helping people manage concentrated stock positions. And honestly, this is something that we talk about with clients all the time. And I was like, we just need to do an episode about it. One, because I think it's valuable. People don't know the tools, and there's a lot of good tools out there too. We talk to a lot of prospects who honestly, this is a good way for them to get to know some of the things that we'll think about and talk about. So Ben, it's been a while, but man, appreciate you coming back on.
Well, appreciate you having me on in the first place. I love doing it. It's always delightful, and you always have such great topics and interesting guests. So I'm just delighted to be one of them.
Yeah, man. Well, appreciate it. So I think, when we think about concentrated stock positions, right, it comes from many things, right? One of them is, hey, I work at Amazon or Nvidia or something. I'm an early stage employee. I've gotten tons of equity that's continued to vest over time. Maybe it's some options, but most likely RSUs over a long period of time. Some of it is, you're a private company and it's really blown up over time. Some of it is, I'm going to sell my own business. Some of it could be, just different investment that you bought when you were really young and that's built up for a long period of time. But all of these create some really interesting planning tools. And, in the financial planning world, there's only so much you can do on income tax planning. There's quite a bit that we can do here on this capital gains tax planning, whether we choose to sell, whether we keep, whether we diversify through other ways. So when we think about somebody with a concentrated stock position, what is one of the first tools that comes to your head to think about utilizing?
I mean, there's so many tools, but I think the first question that usually comes to mind is, what's the plan? Like, does the client have a preference towards keeping it for some specific reason or starting to diversify in some way? And usually they're talking to us because they want to diversify in some way and maybe keep a portion. Maybe. Depends on the situation, of course. Sometimes that's not even always an option. But usually when it comes to diversifying, even within that, there's a couple of categories of tools to pick and choose from, right? There's sort of things like as simple as just selling it slowly and trying to manage the tax, but just sort of dealing with the taxes. There's a ton of tools to start to manage that tax, as you were just alluding to. And even within that, it's sort of like, well, you could go the charitable route. You could go the kind of keep it and be very strategic about it. Use things like derivatives-based strategies, options-based things, pre-variable forward. So there's so many different categories, but it starts with that first question. What are we doing for? How much do we care about taxes? What do you need for liquidity? And all of that still then comes back to the other part of this, which is if it's a concentrated position, what's the risk of hanging on to too much of it?
Yeah. I think the conversation always starts with financial planning, right? What do we need money for? Are we upgrading houses? Are we covering college for kids? Are we doing, X, Y, and Z? After that though, right, then I think there's 2 sets of tools. There's one that's I want to keep this stock, but I want to maybe create income around it. I want to do some other different things with it. And then there's hey, my goal is to sell out of it. What different tools can we use? Mm-hmm. So I think let's kind of start with the tools, the options, and how they work if you do still want to keep some and have some exposure around it.
Yeah, sure. So with that goal in mind, I would probably start the conversation with saying, all right, there's things as simple as, writing covered calls or buying protective puts, or maybe doing a bit of both, which is a collar, just so that you're creating some level of hedging or stability around the entire size of the position without being forced to sell any of it, realistically. And so we've got clients doing kind of all 3 of those things. Some people are just writing covered calls to get a little bit of income out of the position. Usually, if they're doing that, it's because they need the income, and they're not going to be taxed at crazy high rates because options are usually short-term gains. So the income's not super tax efficient. But those are all relatively straightforward things, right? Buying a put is just using that income to then cover the downside. But I kind of like the idea of a prepaid variable forward for this kind of category, right? Because that's
Before we get there,
essentially
really quick though. So let's say I own $10 million of NVIDIA and I don't want to sell it. So I want to do some covered calls or a collar around it. Use that example. Like, what does that look like?
oh yeah, sure. All right, you got $10 million of NVIDIA. Probably what you're doing is selling covered calls on an ongoing basis. And usually you want to pick something like 10 or 20% out of the money, depending on how long away, how far the maturity is for the call. So you give yourself some upside, but you're getting the income based off of whatever that strike price is. Maybe it winds up being a couple percent a year. Sometimes it can be as high as 10% a year if you want to get a little bit closer to that current strike price and really target the priority of income. So realistically, you can probably, using options, probably create, with a $10 million position in NVIDIA, something that's relatively volatile, a couple $100,000 a year of income without taking too much risk. You could probably create more than that. You probably can get close to 7 figures of income depending on what you want to do and how frequently you want to roll these options out. And then if that's the case, you're probably then also buying some protective puts, likely. And that might be something, again, close to the money to try to lock in the exact position where you're probably using substantially all or the vast majority of your covered call income to pay for puts to just kind of keep that protection as high as you can. But we've also got cases where it's more like, okay, I want to get a little bit of income off the position and then really only protect against like pretty bad scenarios where you're paying a lot less if you're saying, okay, I'm going to buy a put that's like 30 or 40 or 50% out of the money, just to make sure if something collapses, I'm still good to go with the rest of my life and not have to worry too much about selling this thing at a tiny fraction of what it's currently worth.
Okay. So I think that one makes sense, right? That's a strategy. You're going to get some income around it. You're basically protecting the downside, having a cap on the upside to then get some income from it. And that's probably it's not like simple for you to do on your own, but it's one of the simplest. If you're like, I just want to keep it, but I don't want to risk too much. Give me a little bit of income. Okay. Yeah. So then we start to think about prepaid variable forwards.
Yes.
Well, let's walk through those.
So much fun. I mean, they are a little more complicated, which is why I like to do this. You know, I get very excited with the advanced strategies, so I do this sometimes with my fingers. But the essence of it, without using crazy terminology, is you have a put and a call, right? You basically create a collar around the position. So you cut off a portion of the upside and you cut off a lot of the downside. And you then pair that with basically a loan against the value of that entire protected portion of the position. So going back to that same example of $10 million in NVIDIA stock, one way to do it is to do what's called a costless collar, where the cost of the sold call exactly equals the cost of the purchased put. So there's no real cash inflow or outflow. And let's just use basic numbers. Let's say that means you write a call at 20% outside the money, so anything above 20% on the upside is cut off. But then you protect everything, 20% out of the money on the put side. So that 80% of your $10 million NVIDIA position is protected. You can basically get a loan for roughly $8 million for several years at a time. There's a bunch of different ways to structure it, but essentially you would get that $8 million loan to then do essentially whatever you want with, but realistically, what the vast majority of the advice is use that to diversify your investments in some way. Right? Maybe it's as simple as just creating a portfolio that, can maybe either perform differently or at least has different kinds of risk than just the NVIDIA shares. Maybe it's something more advanced, like using, direct indexing or long-short direct indexing to create a bunch of losses or try to be very tax efficient so that you can use those losses from that portfolio to offset future sales of that $10 million NVIDIA stock. That's a pretty powerful concept we're probably going to come back to a couple times in different scenarios, but it works really well in combination with that prepaid variable forward structure of, options-based protection with the loan, so you get all that liquidity.
Okay. Yeah, so I think that one obviously is a little bit complex, but really to summarize, right, you basically have a cap on the top, you have like a bottom as well. The goal is that it's staying within that. The wider the range, I mean, then you're going to get basically a bunch of liquidity. You use that liquidity either to diversify, you can use it for long short direct indexing, regular direct indexing, but kind of can push off the gains by just borrowing and then having another portfolio. If the goal is to sell around it, then you'll probably do some direct indexing. If the goal is just to diversify, then you'll probably just go into basket of ETFs, globally diversified, et cetera. So it gives you this, you still hold it, but you get exposure from the market in other areas. And then obviously there's still some loan costs associated with that as well.
Mm-hmm. Exactly. And like some people will just take that funding and live their life with it and just kind of sort of bank on the idea that the stock is protected to some degree. And if they have to, ever close out the prepaid variable forward, they can deal with it at that point in time.
By selling that stock.
By selling the stock, and kind of covering everything. So there's plenty of ways to kind of create a end game with that kind of structure. But I think you hit the nail on the head with one thing you said, which we should emphasize, which is that all of these things kind of, at the very least, delay the need to realize any big tax event, right? You don't have to sell things with these prepaid variable forwards. You're not forced to sell things with buying a put, for example. You might be forced to sell something with selling just calls, but usually you would avoid that by moving away from it. So like all of these structures at least help delay or maybe eventually completely put off a tax event and manage the risk around the position, manage the potential liquidity and diversification needs around there. So that's why I like all these, this category of kind of options-based ideas.
Yeah, yeah. And then there's probably one, I mean, what other ones are there left in this structure? Is it structured notes?
Yeah, I was going to mention that. So structured notes are an interesting way to really focus on the income side of things. They're pretty customizable, but usually you want to fund a structured note. Usually you want to fund it with cash, and you can raise cash from a part of a position you've already got. Because if you're looking for income, right, income structured notes are one category of structured note. And usually the way they work is it's kind of like, hey, we don't need to participate in the upside of this stock at all. And in exchange for giving up all that upside, you can get in some cases, double-digit, percent return income per year, as long as it doesn't go down by X percent. And X percent could be a pretty big buffer, 30, 40, 50% downside protection for that kind of thing. But usually you want to buy them in cash as opposed to contributing your position to it. So certainly it kind of fills the role of you've got a concentrated position, and maybe you want to carve a portion out for income so that you can kind of retire and live off of this and sell off into the sunset, or get income for whatever other need you have. But yeah, it's just sort of changing the risk in a way as opposed to just hanging on to the stock.
Yeah. It feels like the one that we don't ever typically recommend. I don't really see people talk about much. So I don't think it's one of the common strategies used, but it exists.
I agree. It's out there. It's worth learning about. We just don't wind up with a lot of people who need that high level of income because it's also kind of tax inefficient, when you get that income.
Yeah, especially because most people we're working with are still building other businesses, still working in the 37% bracket plus. And so then you're just getting all this income being taxed at, 40 to 50%. Is income really the right play? Rarely, because they don't really need it, right? You're probably going to diversify, if anything.
Totally. And in fact, the one scenario that pops to mind for this is someone who had a concentrated position, used a portion of it to go into structured notes that were tied to other stocks, so it's a completely different source of risk. But he was going through kind of a different shape of his career path that was kind of temporary. So that is going to create income while he needs it. And then we can essentially either abandon that idea or keep going with it over time. But you're right, it's not terribly common. I still think it's an interesting tool, for sure.
Yeah. Okay. I think that's really all the ones of keep the stock and do something around the stock. Now let's think about some of the capital gains, the tools to help reduce the capital gains taxes or defer them.
Mm-hmm. Yeah. Okay. So whole bunch of things in that category, right? I mean, the big one that everyone kind of hopes for that is unfortunately not terribly likely for a lot of people is if it can qualify for, QSBS exemption, the qualified small business stock exemption, great. Fantastic. Right? Yeah. You can get $10 million, and at this point maybe it's $15 million going forward of completely, wiped out free taxable capital gains. Great. Would love to have $10 million plus of tax-free gains. But that pretty much only applies to folks who are either very early employees or the founders themselves. of businesses that have been around for at least 5 years. They've been C Corps, right? There's all the rules that go along with QSBS. But it's lovely. What a great part of the tax code. But there's a ton you can do if it gets sort of, it's not eligible for that. What else can you do to mitigate all these taxes? There's sort of the one category that maybe we'll come back to, but sort of like, do you want to give any portion of this to fund your charitable goals, right? If you've got long-term charitable intent. There's a lot of strategies, I would say 3 in particular on the charitable side, that are very good from a tax perspective and better than like just selling the stock and then giving cash to charity, which most people think of as their charitable strategy. Like, well, I'll just give some money to charity. There's better ways to do it, right? The tax code's not super straightforward for this kind of thing, but if you want to use a portion of your 10 million of NVIDIA or whatever it might be to go towards charity, looking at things like donor advised funds is probably the most common way to do it, because you can put the position into the donor advised fund. That gives you the income tax deduction on your Schedule A, your itemized deductions for that value, and then you sell it once it's inside the donor advised fund, so that you don't have to bear the capital gains hit at all, right? And once it's in a donor advised fund, it's a charitable vehicle, so basically no one's paying that capital gain. So that's really powerful. You got a lot of flexibility with that kind of vehicle. Similar, but slightly different story if you use things like a charitable trust. There's different kinds of charitable trusts. We probably talk about charitable remainder trusts the most, where again it's similar. You would put the shares directly into this, entity. The only main difference is instead of putting it there, selling it, and then kind of giving all of those proceeds to charities over time in a very flexible manner, with these kinds of trusts, usually you get some form of either income back on a year-to-year basis or something at the end of the term of the trust that comes back to you or your heirs or your family members or whoever it might be. But usually it gets chosen by the folks who kind of want that income portion. We can go pretty into the weeds with this, but I think charitable remainder trusts are actually really interesting. It's kind of funny because they can be very valuable tools, but they actually don't get chosen at the end of the day by a lot of people. A lot of folks do wind up going with a donor advised fund just for the simplicity, right? Maybe that return on complexity is part of the calculation. But anyway, I digress a little bit. The third one is basically private foundations, right? Where you're really interested in going pretty full into charitable mode, not just from let me give some money over time, but let me also operate a foundation, right? Those kinds of things are usually a bit more onerous to maintain. There's a lot more effort involved. And you've got to structure them right and kind of follow the rules correctly. But for people who are starting to get into much higher levels of assets that you want to give and total net worth, it can be a really powerful tool, especially if people in your family, you included, want to be involved at that level of kind of running an organization. So I usually tell people it's not necessarily super worth it unless you're starting with usually at least 3 to 5 million that's going to go into the foundation, which is a pretty sizable threshold.
Big amount, yeah.
But all 3 of those, right, donor advised fund, charitable trusts, private foundations, all 3 of them are much better tax advantage tools to be talking about than let me just sell it and give some cash to charity.
Yeah. And a lot of people, I think a lot of people are oh, let's use the example of 10 million NVIDIA. Oh my gosh, I don't want to give, I only give 25K to charity a year. I don't want to give away too much. It's well, if this is going to be your big capital gain event, should we say, hey, you want to give 25K to charity for the next 20 years, 500K? Let's donate 500K now because you get a $500,000 deduction against your income when you're in your highest bracket. So let's say you're California, 50% marginal bracket, that's 250K of tax savings. You avoid 500,000 of capital gains, right, which is another 37%. So, okay, great. That's, what did that be, another 185,000. So you really didn't have to spend very much to give, and then you can grow that money inside of the investment account and use it. So this isn't something where we're hey, you have 10 million of capital gains, let's donate 10 million. It's a tool to probably be layered on to some of the other ones.
Yes, actually, really good point. Really good to use this in conjunction with either one of the ideas we already talked about or one of the ones that we're probably going to talk to next, because I feel like we've got some good heavy hitters in the bag.
Yeah. So let's go into some of these ways to diversify.
Yeah. All right. I'll start with kind of what I consider kind of one of the top strategies or ideas for how do you diversify in the most tax efficient way possible. That I think is direct indexing, and specifically long short direct indexing. where you can take the position or some portion of what you want to start to diversify. You can put it into the account directly, or you can put cash in after you've sold it. Ideally, you would put it in before you've sold it. And then basically in these direct indexing accounts, the way to do it is to essentially start to build up the portfolio over time so that it's very aggressively targeting, realizing short-term and long-term losses. And in a long-short account, long-short strategy, you can do that pretty quickly because no matter what direction the market is moving, some part of that long or short portfolio is going to have some losses in it. You can then use those losses to keep whittling down the position in a tax-neutral fashion, right? So usually, for example, if someone has $10 million of NVIDIA, we might start by realizing a portion of their, tax gain. Maybe it's a couple $100,000 or maybe less, just to free up some of the cash around it, and then leverage it with the long-short strategy in order to create as many losses as we can as quickly as we can. And in some instances, it's been spectacular. In some instances, it takes a little bit longer to build it up. But like this year has been a pretty stellar year for this kind of strategy because of the volatility that's been there mostly throughout the year, but especially back in April. Around the tariff announcements, there was tons of volatility. That just created so many opportunities for these kinds of strategies. There was just a ton of potential buildup of these losses, and then usually what they're targeting, what the strategy itself is targeting, is like pretty strict adherence to the performance of the underlying index. So if it's targeting the S&P 500, the performance is actually quite similar to the S&P, or if it's targeting the MSCI ACWI index, which is a more global index, you're still going to get performance very, very similar to those indexes, but you're going to have all these tax losses. So we've got some examples where people put in, maybe a couple $1 million earlier in the year, not even the beginning of the year, but earlier in the year, and they've already got $400, $500, $1,000 worth of losses, while their performance is, positive to the tune of 10% plus year to date. In 6 months, those are pretty solid numbers.
Yeah.
Right? 20 to 25% of the entire portfolio already having realized losses. That's a lot you can use to then offset either additional sales or offset the sales of things you've already done over here. So that's probably the most commonly chosen structure or strategy out of all these things. It's just usually done in combination with something else, meaning like it's funded from a prepaid variable forward or something like that.
We have a whole episode coming out later here too, just on direct indexing, long short direct indexing, who it makes sense for, how it works, et cetera. But I think it is a really, really good tool. And typically it's like the more time in the year you have, the better. So let's say this person with 10 million NVIDIA, one thing they might consider is they might sell a few million of NVIDIA in January, go into long short direct indexing, use that to offset as much as they can. And then the next year, what do we have left over? How much can we sell? And they keep selling tranches, adding to it and benefiting more from it. So I think that's one way. Another way is some people would borrow against their NVIDIA to put it into a long short direct index, right? And so now they've been sold, rack up losses for a while, and then kind of structure in and move from there. So really, really good tool. I think it's one that is talked about more and more today. And I think in the next episode, we'll go into who it's a fit for and who it's not a fit for, because I think it's right. Like there's a lot of people talking about it. It is not a right fit for like 97% of people, but we work with like those 3% of people that it is an amazing fit for. But then we have clients who it absolutely just does not make sense for, and it's not something that we talk about with them. So I think that's good on that one. What are the other tools in this area that you think of?
So I think there's a couple others that have had their uses, and sometimes they've become more or less popular. But like one that comes to mind is kind of exchange funds, which have been around for a long time. Where basically the idea of an exchange fund is let's say I put my NVIDIA shares into this exchange fund. You don't necessarily know what else is in it, but the goal of the exchange fund is to try to again get close to somebody's index. But if I put my NVIDIA shares in, and let's say you put your Microsoft shares in, and someone else puts their Costco shares in, we can just pick a bunch of companies. The idea is that over time, people have contributed a whole bunch of different stocks to it. While those funds are inside the exchange fund, it's trying to diversify these positions. The downside to it is that it usually takes a while for you to get your position back out again with a lot of the gains actually, offset. So there can be sort of an illiquidity component to it. there's a little
Isn't it
bit of
supposed to
a,
be like 7 years or something?
yeah, that's right. It cannot, yeah, it's the usual number that I would suggest. People should expect to keep it in there for 5 to 7 years, at least,
Yeah.
sometimes longer.
Yeah. It's basically like you get to put your one investment into a basket of other investments
Hmm.
and your cost basis continues on, but now you're invested in this basket versus your one. So this is for people who are like, I'm very concentrated. I want to diversify, but I don't want to pay the gains. It diversifies and basically does that for you. You just don't necessarily, you're not like, I'm about to sell and take it out because you still have that same low basis.
Yeah. And it can be good for people who like really don't want any kind of leverage for any reason, right? Because some of those strategies benefit more from using leverage, at least to some degree. This one doesn't really have that component to it for the most part. And the next one behind it is probably opportunity zone funds, right? Using qualifying opportunity zones to at least defer the gain for a long time. That can be a strategy with, some other wrinkles to it. 'Cause obviously, with a qualified opportunity zone fund, usually the intent is to then invest
Hold
the
it for a
proceeds
decade. Yeah.
for a decade, and usually it's in real estate, and only in real
Yeah.
estate that is specifically set by state governments to qualify. The downside to that one really is that there's a lot of potential investments that are difficult to research and do full due diligence on, so you don't know if it's going to be the best return on the investment side of things. Tax benefits are certainly there, and the tax deferral is certainly clear, but it's not quite the same. So it's for people, I would say, for more people who are really interested in the real estate space.
Yeah, if you really want to diversify, right, and you want to get that money out and you're fine avoiding the capital gain for 10 years and the entire growth and that's tax free, it's great. You divert your capital gain right now till after 2026. That's slightly changing. So you're going to defer your capital gain. You still owe the capital gain down the line. Sure, you could do some direct index, long, short direct indexing things along that time to kind of bank some losses to offset that deferral. Then you have to hold for 10 years, you get tax-free growth, but the investment has to be good, right? Tax-free growth is good if there's great growth, but if your after-tax benefit is lower than what it would have done elsewhere, not necessarily the best tool. And I think a lot of times when people think about all these tax tools, they really think about tax savings. And I want to remind people that the lens to look through when you're thinking of tax planning is total after-tax wealth, right? It might reduce taxes, but if it doesn't do anything good from there and you end up with less money, you're worse off. Right? It really is that simple. Think about, where do I put my money that leads to the most money after taxes, not just where do I have that has the most income or the most tax savings, et cetera. You want to think about that after tax lens.
Absolutely agree. I think that's one thing that's pretty easy to forget, because like the idea of the strategy sounds super interesting and sexy, but you have to keep that back part in mind of like, what does this actually mean in the long term of how much I'm really worth?
Yep. Yep.
Something comes up with your strategies, because there's all these other less common strategies out there that have to do with concentrated positions and tax planning in general, and maybe some are really real estate focused, right? Like kind of the Airbnb, like short-term rental strategies, solar strategies, oil and gas.
Those are all
right?
income plays, but like at the end of the day, like your taxable income is really high. I'm sure you
Yeah.
have income, still a tax savings tool. Those work, but I think solar is the perfect example of like, sure, you can have solar, you can try to get your material participation, you can take that income deduction, but most times you're not expecting very much returns and you're expecting illiquidity for like 20 plus years. So like,
Yeah.
does that fit for the occasional person who sold for 100 to 500 to $1 billion? Sure. But like, if you get a couple $1 million, a lot of these tools start to be like, you're just trying to do too much for not that much tax savings at the end of the day.
Right. That one's probably got one of the most difficult to justify, like return on effort. That one's pretty tough.
Yeah. Okay. Any remaining ones you think we should hit on? I think these are like the main ones that we typically evaluate.
Yeah, I think those are the key ones. Again, like sometimes we'll hear, a specific client situation where all of a sudden it makes sense to, bring into play various other techniques that might introduce estate planning techniques where you have to consider either gifting it to a trust, selling it to a trust, right? There's all kinds of estate related things, but those don't have to do so much with managing the capital gains tax impact of the position itself.
Yeah,
right?
you can
Usually
maybe
that's
stack
what
some QSBS eligibility in a trust or
Yep.
some certain things like that. Or like, hey, if you have a trust that's concentrated in a lot of growth, you potentially can exchange in assets that have a higher basis if the trust allows. So there are some things there that can get pretty complex. But I think for today's conversation of like, we don't have to go through every tool, but what are the main tools to consider? I think we hit them on the head.
Totally agree.
So, all right, Ben, well, appreciate you coming on, man. Everybody, thank you for listening. make sure you tune back in. We about probably 3 to 4 weeks from now, we're gonna have another episode with Ben, really getting into direct indexing. It's kind of one of those like huge topics today, and it's a tool we absolutely love, but we also know it's a bad tool for certain people. It's a great tool for other people. So make sure to tune back into that one. Please rate and subscribe, and we'll see you guys back next week.